There is a Solution for That is sponsored by VARK Solutions. VARK Solutions helps small businesses succeed by delivering expert QuickBooks bookkeeping, consulting, quick-base development, and integrated solutions. If you own a small to medium-sized business that uses QuickBooks or QuickBase, the experts at VARK Solutions can help. In business since 1999, with people who care and the knowledge and experience to solve your toughest problems. Visit VARCsolutions.com for all your QuickBooks needs. Welcome back to another edition of There's a Solution for That, where we help small businesses succeed by discussing challenging business problems and best-in-class solutions. All right, welcome back, everybody. We've got a great podcast episode today. We're going to be talking with Jackson Payne at Viking M&A and really just digging deep into the whole topic of how to grow a business value, in terms of a future sale. Whether you're on the buyer side or the seller side, there's lots of different topics to kind of learn about. And so let me just go ahead and kick it over to Jackson just to kind of just tell us a little bit about you, a little bit about your firm, and kind of how you got started in this.
Okay, sure. Yeah, Viking, we've been around for about 30 years, headquartered out of Charlotte, North Carolina. And what we do is we help people sell businesses. So we focus only on the sell side, um, helping, and there's a couple of buckets here, and I'm maybe getting out a little too soon out of the gate, but we have business brokerage, which we call that as pretty much SBA deals, $1 million to $5 million enterprise value, because that's the SBA limit. Above 5 million, we call mergers and acquisitions, or M&A. That's typically not an individual buyer. That's more private equity, family office, strategic, things like that. So that's what we do all day. We meet with business owners of all industries where we are industry agnostic, and we help walk them through that process. I'm the managing partner of our Houston and Austin branches, include San Antonio as well, along with my brother, who I recruited to help us grow that, because it's obviously a wide swath of territory there. And how we got into this was unique. So we had a family company that we sold in 2014, and we thought we were the smartest guys in the room. And so we did the deal without representation. And I like to say that's the most expensive education we ever received. We did the deal straight with the buyer. And man, we made every mistake in the book. The we were in the oil and gas industry, so in oil field services specifically, if you know anything about history in oil and gas, we did that deal in June of 2014. Oil was like $110. We thought we were smart, but it was really just oil was $110. We could charge whatever we wanted, and we did the deal. We argued over the price of the deal. We got their terms, which meant we didn't get enough cash at the closing. And then in the fall of 2014, the price of oil became a bunch of falling knives, as they say, and our rollover equity was not worth that much. So a very good lesson for me. From there, my brother Coleman, who's not on this call, but my fellow managing partner in Texas, he went to Deloitte M&A. He'd actually started there out of college, worked with us, and then went back to Deloitte M&A. And then I worked on the buy side for a family office for a while before migrating over to the sell side, and eventually with Viking. And so between us, we've been on every side of the deal, from being the seller to the buyer to the integration to the prep. We've done it. We've done a little bit of all that. Gives us a pretty good view of a deal. Being able to, we're obviously now helping the seller, but we understand the buyer. We understand what everybody needs in a deal. So anyway, that's who Viking is, in a very, very high level, and that's how I got into this. Like I said, making those mistakes kind of gave me a love for this process. And now I try to take those, those scars and help our clients navigate.
Well, thank you for the intro, and there's a couple of thoughts that kind of came to my mind as you were talking, and so just 30,000 foot view. You mentioned a couple different buckets, right? So that 1 to 5 million SBA broker type of deal, and then you've got the bigger M&A deals. Just big picture, what are you seeing more of? Just, I mean, I imagine it's all over the place, but what are you seeing more of the smaller deals, more of the bigger deals?
That kind of varies, but in our Texas office, we do have more bigger deals. I guess, everything's bigger in Texas, but I think there's just a larger quantity of SBA deals just in the world. I think it's very hard to build $1 million business. So it's harder to build a $5, $10 million business. So I think from a quantity perspective, we still have more SBA deals. So we never want to, get out. That's what Viking was built on. It was started almost 30 years ago by a father-son team, and Main Street SBA deals for 20 years. That's all the company did. It's grown as we've added people. We now have 60 some odd advisors, 15 offices, and a lot more talent. As we add those people, we've migrated up. But we never want to get away from those SBA deals, those Main Street deals. So I still think there's probably more of those just
More of
from
the
a sheer
smaller.
numbers perspective.
Well, so this is something that, I always try to think like if somebody was sitting next to me saying, "Hey, ask this question." I try to have that ticking thing in my head all the time. And so one of the questions that I would have is like, what qualifies an SBA deal? So you mentioned like 5 million, but is that the limit? Has that limit changed over time? Will it be 7 million in a couple of years? I mean, what's the trends?
That's a really good question. I don't anticipate the government moving quickly. They never do. Ever since I've been doing it, that's the limit, and that's the limit of the loan that they can give. So, the value of the business can be a little bit more than that, and still financed entirely with an SBA loan. But and we do some deals, which you're familiar with some of these, where we can do a pari passu loan on top. So there's technically the buyer's financing it with two loans, an SBA deal, and then a more conventional secondary loan. Um, but yeah, what qualifies them, the SBA, it's a great program. There are some hoops you have to jump through to do it. So that's the downfall. But the amortization for a buyer is the best you're going to find to do an acquisition of this size. But you're going to need good cash flow. I mean, obviously everybody likes that, but the SBA is going to really weigh heavily on tax returns.
Hmm.
So and the thought there is there's no SEC overlooking the private business world bookkeeping, and they're not all pure GAAP accounting. So the thought is if we value it off of the tax returns, nobody's over reporting their earnings to the government. So that's where that comes in. So there's a few more restrictions on add backs and these kind of things. But essentially, tax returns are going to drive the day, which is important for people to know when if they're in that space, that size range, and their company would sell most likely to a buyer using SBA financing. Well, they need to know about their tax returns because as they file their tax return every year, if they can lower their valuation when they lower that taxable income. And so it's always good to get them ahead of the game so that we can let them know that.
Yeah, and let's actually dig into that just a little bit more, a little bit like one level deeper, because I think there's that what you just said there, I think could be missed. And I know it was not necessarily something that was clear to me, when I first started learning about this type of industry as well. And so tax returns, right? It's like, we do our company, we do bookkeeping for clients, and we're trying to make sure that the financials are accurate. But at the same time, if somebody's trying to lower their taxes, their whole goal is to reduce the net income. But it sounds like that strategy is great if you're just running a business, but not so great if you're trying to get over time a larger valuation for an exit. So is that tell us a little bit more about your thinking and as you might help a seller.
Yeah, so obviously, we meet a lot of business owners and that are allergic to taxes. And I get it. Nobody wants to pay tax. And there are certain perks to being a business owner, right? You may run your car through there. Uh, I suppose the IRS isn't listening to your podcast here, but some people are running uh, a lot of personal expenses through a business, and maybe they're doing maybe they're expensing things that should be capitalized on the balance sheet. Maybe they're being being generous with what they call certain things, within the accounting.
Right.
And I mean, I'm sure if you guys are managing books, you're told to do all kinds of things. I'm sure there are certain things that we can add. The term, it's a slang term, I guess, is add back. We got the tax return. The tax return has a certain number on it. That's the cash flow. An SBA deal, the metric is seller's discretionary earnings. So their W-2 income is added back to that. And we can, obviously, your depreciation, your interest, but we can do certain add backs, but if they're very, very hard to prove, one typical one is travel. People throw their personal vacations and run them through the business, but they also have business travel. So that's very, very hard to prove. We can't really do a lot with that.
Right.
Um, but essentially what we tell people is if you pay tax on, so if you're planning on selling in the next couple of years, in a perfect world, I've got at least two, preferably three very clean tax returns. Um, and so let's say two tax returns plus current year. Those tax returns, not overstating those personal expenses because you pay 30 cents of tax on every dollar of net income, but you gain about three something dollars in valuation.
Hmm.
So you're jumping over quarters to get to nickels, those if you're not planning that, right? And you're
Right.
gonna and another key thing is CPAs typically don't weigh in on that. They're typically cut tax, cut tax, cut tax.
Right.
So I'd say the biggest hurdle that we run into with business owners is two things, which one is what you guys focus on, which is poor books and records. And number two is you just didn't plan it and you're running a lot through there. Another one is not necessarily dishonest or anything, but it's cash basis, holding checks till January 1 and things like that. So if you're pure cash basis, you're not putting the revenue into the right month or the right year. You're kicking the tax
Right.
down the road. Well, the valuation is being suppressed. So
Yeah.
it's just good for people to understand that.
No, those are great suggestions. Yeah, and like in the accounting world, I think one of the terms is called the matching principle. Like, you
Yeah.
match your revenue when you earned it, things like that. So some of those things are normal and natural, especially if you've got long-term projects you're doing. You might, record that income in the future when you actually, finish earning it. But yeah, most business, I mean, yeah, we do get requests on occasion, and love it or hate it, we have to be above board on that stuff when it comes to our clients and what we suggested them. So we're always advising them to be above board and to do things right. Although you'd be surprised at some of the requests we do get. Um, it's interesting sometimes. Well, so let's actually go back a step. So you mentioned when you guys had your own business and you were looking to sell it, you uh, basically did it on your own and learned a lot of lessons. And so using that as context for this next question, why should someone use a firm like you guys when they are looking to sell a business?
Yeah,
Like
that's
what
that's
what
a
are
good
some of those
question.
mistakes that you can help them avoid?
Yes, and we talk to a lot of business owners that have been contacted directly, especially when they're a little bit bigger, when it's in the M&A space, where you may have a private equity company or strategic, maybe a competitor or someone in the space just calling you directly saying, "Hey, Brad, have you ever thought about selling? I'd love to buy your business." Um, and the first thing, remember, so after we sold our company, then I worked on that side of things too. So first thing the first reason to come to someone like us is if you have one buyer, you have no buyers. Right? We want to go to the market with it, and because you want to get what the market could bear. And if you have one person, you're only talking to them, you have no leverage whatsoever. They need to know that there's other people involved to sharpen their pencil. So I always tell people, okay, put the phone down, don't talk to them, introduce them to me right away. And you tell them immediately that it's not just, Joe business owner, it's a professional, M&A group is coming in here, uh, changes the tenor of it. Typically, those people aren't even the buyers because once, they're trying to, I'm not going to say they're trying to take advantage of you, but they're not showing you all their cards. We'll say it like that. And so you want to take it to the market and run them through a process that's competitive. So at our Texas office, we average 68 NDAs per listing. So if
Wow,
we've
that's a
got
lot.
68 people and we talk to each one of those, I think what we're really good at is finding a really good fit. Um, we want to find our sellers, our typical sellers had the business 20, 25 years. They care about, yes, of course they care about the money, but they care about more than the money. They care about their employees, their clients, their vendors, um, and they want the legacy to continue. So we're spending time talking to each one of those 68 people, narrowing it down to try to find a really good fit. And along the way, um, we're weeding out the weaker of the potential candidates. What that gives the client is from a value perspective, you're going to get what the market could bear. You're going to get, there's also just not, there's more than price. There's the terms. When do you get the cash? Do you hold a seller note? Do you have rollover equity? All these things. What's the transition? Um, so the more people involved, the more competitive it is. I mean, we all understand that that's better for the client. So that's number one. Number two, that's probably one and two. But number two is you have just because you get an LOI, it doesn't mean that you've got a deal. There's still 60,
Letter of
90
intent.
days.
Letter of intent for those that don't know what that term
Oh,
is.
else, yeah, sorry. A letter of intent can say, I have a letter of an, I intend to buy your company for such and such, and they lay out the terms, but it's non-binding.
Right.
No group gives a binding LOI. They can back out for any time, and the phrase that and it's also exclusive, which means you give them exclusivity, so you can't talk to any other buyer, and we call that tying up a deal, right? And there are a lot of buyers that just they go out and make 10 LOIs just to tie up deals. They only have intention to buy one or two,
Hmm.
um, and they're just messing around with you. So you don't know that. If you've been selling widgets, you haven't been selling companies. You don't know, and they're taking advantage of that. They do this. They have people on their team that do that for a living. You need somebody that does that for a living in the middle. But there's a whole lot of reasons why a deal can fall through between LOI stage and closing. That's usually a 75, 90-day process,
Yeah.
and the you need somebody walking through that with you, which is why at the beginning we do a lot up front. We don't just take everybody to market that calls us. We're going to do evaluation and an evaluation where we're looking for the readiness. What are the things that can keep this deal from getting to the closing table? Get out in front of
Yep.
those things, and if need be, talk to the client. Say, look, you need to do ABC. And so, if you haven't done any of that, and you've been, like I said, selling your widgets, it's kind of there's a lot of do-it-yourself for entrepreneurs, and I get that, but you know, this is one of those things that you save a fee to someone like us, but our fee is really more of an investment. You're going to cost yourself. The other thing that people do is by trying to handle it themselves, we see often they come back to us about a year later, they couldn't get a deal done, and now they've taken their eye off the ball and the business has suffered.
Right.
Numbers are down because they're taking calls and they're messing around with these buyers and they're not running their business. So,
Right.
we need some time from our clients, but we're doing that heavy lifting. We're taking all those calls. So those are the three main
Okay.
reasons. We have a blog series on that, by the way, that we wrote, a 5-piece blog on. I just got an unsolicited offer. What do I do? Because it probably deserves more than just 5 minutes.
I probably get 5 emails a day. So
Yes.
I think we're all getting those, I guess, if we're on LinkedIn with certain titles and things like that. Well, let me ask you this, just at a tactical level. So you mentioned LOIs. How does a firm like yours tactically prevent these, rogue buyers tying up a deal? Like, what are those signs, or like, what are you doing strategically, tactically to prevent that from happening?
Yeah, like I was talking about our process a minute ago, we're going to talk to each. If you sign an NDA with us, so you ping us about one of our deals, a buyer. You sign, the first thing they're going to do is get an NDA, and it's got some financial information that we're asking for. And I mean, that's not strenuous, but we want to know if they can do the deal basically. And the first thing we do is talk to them. If they sign an NDA, we are talking to them. And so uh, the goal of that is to find out who this buyer is. Are they a good fit? Obviously, there's a lot of tire kickers. They can never do a deal. But even if they're real players, we're finding out uh, uh, as much as we can about them. So the reason we do that is for that right there. We want to know who the buyer is, what they're going to do, um, how they look at deals, how many deals they do at once, how many deals do they have, how they finance them, how they structure them, how they value them, all those things. So that's the probably the one of the most important things in our process is those average 68 NDAs. We're talking to every one of them.
So
And
you're interviewing those folks,
yes,
qualifying them before you ever allow somebody to actually sign a binding or an exclusive LOI.
yeah, as a matter of fact, we're talking to them before they see anything about the business. So I'm having that call with them, and they're wanting to know, they're wanting to see what's called the SIM, which is the Confidential Information Memorandum. That's just a report on telling you all the details of a business. They want
Right,
to see that, and we want to hear about them. And if the professional buyers get that, the good ones get that, and they plug in with our process. If they don't want to go along with our process, well, that tells us plenty right there.
right.
If they come along with our process, we'll be able to figure it out. I mean, are we going to be 100% with the right buyer? Not necessarily,
Yep,
but through our process, we're talking to them multiple times because that's just stage one. I fast forwarded, there's multiple stages before you're going to get to an LOI.
right.
As we narrow it down from 68 to say 5 buyer visits to come and sit down with the owner, meet face to face, two-way question and answer session. Um, then to multiple LOIs. That's 3, 4, 5 stages. So we've spoken with them a lot. It'll weed out a lot of that. We'll have a pretty good feel just from experience. Obviously, for every, in Texas, we'll do 15 to 20 deals a year. So that means you multiply that by 60. That's how many buyers we work with every year.
Yeah, it's a lot.
So experience teaches you what yeah, I know all the different ways that they're saying I don't have the money. I know all
Right.
the different ways to tell you I may not do this deal. So
Yeah.
we have a pretty good feel, but it takes you have to do that work. You have to get on there and talk to them and not you can't skip steps.
Yeah, it makes sense. Well, let me ask you this. You've used the word right fit a few times, and so I want to dive into that a little bit more with this kind of context. So right fit. I mean, obviously there's people within a similar industry or within the same industry that might be a buyer, and obviously that could be a fit. Um, Strategic acquisitions, things like that. My question is, when it comes to like the right fit. I've heard, horror story after horror story after horror story about, PE firms coming in, buying a business, um, you know, cutting staff, dismantling the business, selling off parts so they can keep one thing, and then their whole goal is just to like double, triple, quadruple sales within a year and a half, 2 years, so they can really sell that one thing. And ultimately, they scuttle the entire company that might have been in existence for 15, 20 years. Um, how did like I mean, one, I'm sure you've seen that before, but like how do you as a as an M&A firm that's really partnering with a seller that's looking for a right fit, that's looking for their legacy to keep going, after a sale as much as possible. How do you help a seller get the right fit with that long-term type of mindset?
Yeah, that's a good question. So by the time we're taking a company to market, we have met with that seller multiple times. We we understand a whole lot about the business. We understand a lot about them, what drives them, why they're selling, what the steps at the why they started it or bought it, what the company's history is like, and what the employees are. We usually don't meet the employees because there's confidentiality concerns, but we understand a little bit about what that company's like internally. And we also, what's the transition that the seller wants? Are they willing to stay for a little bit or they want out ASAP? So each situation is a little bit different, but we understand that when we go to market. And so when we're talking to buyers, you know, we have a long list of questions that we're asking them. One of them is, so tell me about your holding period. Tell me how you plan on exiting this, right? If they're exiting in 4 years, then that's noted. That's not necessarily bad, but once again, you fast forward and you've got those multiple LOIs. Um, we're laying all that out to the client. Hey, there's plenty of there are a lot of horror stories, but there's plenty of good groups as well. There's also plenty of family offices and other family office typically are longer holder groups. They want to
Right,
buy and hold, more like the old school Warren Buffett style and not plan on selling. Not that
right.
they
Buy
don't
and
ever
hold.
really don't buy with an intent to sell. Um, and there's a lot of other people that are just an individual. They call them sponsors or searchers that want to buy a company and they want to hold it long term. So we just want to know all those. So it's not just the money, it's the terms and all the details of the deal, but it's what does this look like for our seller to slide into retirement, or do you want them to stay if they would prefer that? How do you plan on exiting, or how long do you plan on holding? And what's the life going to be like for the employees after close? Is this going to be a jerk? Is this person going to be hard to work with?
Right,
And that's once again all that's part of our process that we're wanting to know. So obviously they're not if they plan on slashing and burning, they may or may not tell us everything, but um, it becomes evident that that's a little bit of a possibility, and they either get cut from the process or um, the seller knows that you know by the
okay.
time they get an offer.
Good stuff. Well, I want to go a little further into another. So you mentioned, or I had the question about like why should somebody use a firm like yours, and you did give a couple good suggestions. I wanted to share at least my perspective on one of the reasons why I think somebody should use you guys or a firm like you guys, and maybe you can kind of expand on it. And that's if you're trying to do it yourself, you've never done one of these before. I know we've personally I've been on the I guess the buy side several times, so I've at least seen things from that side, and I've done a few different deals where they've all been different, right? So I've learned through that process, but I have four, right? That's different than having 400. So you guys obviously have a lot more experience, but one of the things that I kind of learned through the process of buying and or selling, a business is the network of folks that you guys know is important. The law firms that you guys have used before, the banks that you've worked with before, all those resources that have to get pulled in to make a deal work. If you're trying to figure that out on your own, just like, oh, hey, do you know anybody? That can't be quite as effective as going with a firm like yours that's doing these deals 50, 30, 40, 50 times a year. So tell me a little bit about that. Like, what are some of those resources that you tap into, and why does it help a seller use a firm like yours specifically because of the resources that you can bring to the table?
Yeah, that's a great point, Brad. I need to bring you in on some of my sales calls. Yeah,
Right?
but you're right. So lending, 99% of deals use some kind of lending, right? So we understand the lenders who play, and that changes, by the way. You know, it changes from year to year that some lenders pull back based on economic conditions or whatever their portfolio looks like. Hey, I don't want to do anything in this industry. So because we're always doing deals. Lenders obviously like us because we bring them deals, so we have open dialogue with them. We know who plays in what space. We know who's a better fit for certain industries or size deals or geography, whatever that case may be. So, you see that a lot where, hey, they may want to use their bank. Well, I would like you to take a look at these guys just because number one, well, let's talk about SBA deals. If we're dealing with an SBA deal, by the time we're taking it out to market, we've had that pre-screened by three banks that know us. They know how we value deals. They know how we work, and we know how they work. Uh, and that because that's important. Once again, closing is important, and not everybody gets all the way there. Some banks take 6 months to close. We have a saying, time kills deals, so we know who is good to work with. Um, so using the right bank is crucial. It's absolutely crucial. Attorneys, using the right attorney, there we have we usually can introduce people to about three or four, and depending on backlog and depending on fit and all this other stuff, pick one of these. But not every attorney does M&A stuff. Not every attorney does SBA. We want people that are attorneys involved to be in that space constantly, all the time, all day long, every day, because they need to know the market. They need to know the market, all the different clauses in the APA, which is the asset purchase agreement. That's the document that drives the deal. We need them to know what the market is on each one, right? Because, especially on an SBA deal, $3 or $4 million deal, that client doesn't need a $77,000 attorney charge. So we need to get there as efficiently as possible,
Right.
protect them for what needs to be protected. But most of these attorneys know it should land in this range, and let's get it there as fast as possible. So that's a big part of us quarterbacking a deal, is getting that thing closed. And there is a certain thing called deal fatigue. It kicks in, you know, somewhere late in the deal, but let's say our average is 90 days. We
Yep.
don't want that going past 100 days or so. And there's a variety of things that can happen out of everybody's control that could cause that. But whatever we can control, that's important for us to get out ahead of, and that's what we do. So you're right. It's those two are the biggest: attorneys, banks, life insurance. You got to get life insurance. A lot of times people think they've got the buyer needs life insurance for an SBA loan. They think they've got it. Well, they come to find out they don't have enough or whatever, and that can take a little bit. If you're talking about a million
Yeah.
dollar deal, you're going to have to get a physical. They're going to have to check all that. And then what if something pops up in your blood work and yada, yada. So
Yeah.
little bitty things like that. I can't even, we have a checklist for a reason. I can't remember all of them, but it is very important.
Well, and speaking of the life insurance, I try to draw on again some of my personal experience too, and I know that the life insurance agency or company or person that you're working with can be significantly impactful to that, especially if timing is of the essence, right? Because in a recent deal that I was involved in, if I would have gone with the original agent that I had, we would have missed the deadline, 100%.
Yeah.
But using some of the resources you and the bank had put us in contact with was significant. I mean, it helped us not just close a deal, but also close it on time, um, avoiding that deal fatigue that you're talking about. And so, yeah, it's amazing stuff. Well, let me ask you kind of a related question to this, but I think it's something that, again, when I first started getting into this was confusing. I didn't really understand it. What tell us about some of the considerations between like an asset purchase and a stock purchase. I know they're I mean, you're still buying a company, but at the end of the day, it's like there's something different about those two types of things. So what are your thoughts on that? Like what have you seen and what do you recommend? Or is it always just depends?
I would say most of the time, 95-ish% of the time, it's going to be an asset sale. And what that means is essentially buyer is forming a new company, and buying the assets out of the old co. Why do they want to do that? Number one, liability. That liability gets cut. The buyer doesn't inherit anything that happened before. And the other thing is tax treatment. If as an asset, that acquisition becomes an asset on the new co balance sheet that they can depreciate or amortize over a certain amount of time, and that depends on the details of the deal. Um, Now, the downside for the seller of that is that if it's a 100% stock sale, that's capital gains tax, which today, as we talk, is 23.8%. But most asset sales will be a mixture of uh, income tax and capital gains tax, so it's a little bit higher tax. That depends on the amount of assets that you have in the business, like hard assets that you've already depreciated. Those are subject to what's called depreciation recapture, and you've already written those off, so the government's coming back at income tax rates. So those are the differences. There are some private equity companies or bigger people, serial acquirers that know how to do this, that will sometimes do an asset sale. And I'm going to butcher the legal language here, but there's F reorg and there's Section 338H10, and essentially that can help the seller. It's an asset sale that treats it like a stock deal for the seller and can recoup some of that loss that they're paying extra taxes on. But but I would say most deals are asset. We don't really have a lot of that's not something we can really negotiate. It's typically asset. I would assume that every time. Now, sometimes there's an important contract or patent or something that the buyer really wants, and the only way to get that is to buy the stock. And that does happen, but like I said, it's probably 5% of the time.
Okay, so most of the ones that you're working with and seeing, those are asset purchases. Okay, so but bottom line, I mean, if somebody's considering selling, are they ultimately in control of that, or is it more the buyer determining if it's an asset or a stock purchase?
Yeah, I would say it's the buyer that that's the market says the market is dictating that's usually an asset sale.
Okay.
Otherwise, you're probably getting a worse valuation.
Okay. So if I'm a seller, right, and I'm approaching you guys are helping put the company on the market. You're vetting all the potential buyers, doing NDA deals, eventually getting to an LOI. And in part it is part of that asset purchase agreement. That's where you start defining whether or not it's asset sale, stock purchase. And then are you advising a client on that, or is it more like, hey, go talk to your CPA?
We would we would assume an asset sale.
Okay.
We come in and do evaluation up front. At that point, the number we give them is pre-tax, and we know enough to be dangerous on what that looks like. And then we would get the CPA to weigh in on what's called the asset uh, purchase price allocation, and that basically gets a price on all the hard assets. Everything that's not a hard asset, for the most part, I'm oversimplifying a tad, uh, is called goodwill. That goodwill is taxed at capital gains. So a business like a bookkeeping business or accounting business that doesn't have a lot of hard assets, it's going to be mostly goodwill, which is capital gains. So it's not a big deal. But a manufacturer or construction company, they have hard assets. They'll end up paying a little more tax. But we would assume asset sale. We would bring the CPA in as soon as they sign up with us and go forward and start working on that purchase price allocation because they're the group that's been doing the depreciation,
Right.
um, and go from there.
Okay. Well, so here's kind of another one that came to my mind when again, a lot of these things are like I've talked to folks, right? And they said, "Hey, here's something that was different." Um, when how is it different if at all, if there's like actual like real estate involved versus just buying a business?
That's another good question that is different business brokerage or M&A. And I would say a lot of those SBA deals, a good amount, probably half of them own the real estate that the business operates out of. Um, and a lot of times the buyer is the same. The buyer of the business also buys the real estate. So we will come in during the valuation stage or during our first meeting. That's one of the questions we're asking. All right, do you lease this property or do you own it? Because we either need that lease assigned to the buyer or they're going to have to buy it or somebody buys it. And so on an SBA deal, that usually helps finance the deal, number one, because it gives the bank collateral. The buyers typically would want to own it, takes some risk off of having a landlord or whatever. So I would say a good amount of the time that's the case on the SBA deal. On when you're dealing with a more sophisticated buyer, your financial buyers, they typically don't want to invest in real estate. So they want to buy the business. And so we talk to the seller then and find out, do they want to keep the real estate and lease it to this buyer, or do you want to sell it? And there is a network of real estate investors that do what's called a sale leaseback, where they will buy the property and basically close it the same day and lease it to this buyer of the company. So I'm oversimplifying that too. That's a little bit
Yeah.
complicated, but something that we handle. The
Okay.
real estate is a big, that's one of our key things that we need to know and understand how that's going to play out, both from a value perspective, on the buyer perspective, and also that's got a valuation component. So we we ask about that pretty quick.
Okay. Well, so here's another one that I'm curious about. So, like at the very beginning of this podcast, you mentioned you kind of put things into buckets, right? That 1 to 5 million SBA kind of range, and then the 5 to whatever above that being more in the M&A kind of space. What's your experience with maybe deals that started out maybe thinking it's in the SBA space, and then because of the valuation and because of the things that you're doing to help the seller get more money, that it turns into one of those higher value deals?
So we see that a lot when, we I don't have the numbers in front of me, but a good amount of people that we work with at first, we do I mentioned our first step is we're going to do evaluation. When we do that evaluation, we sit back down with the client, tell them, hey, your company's worth such and such. A lot of times they're not ready for whatever reason. Um, and a lot of times if they're close to that line, we'll have a discussion of, hey, look, if you can do X, Y, Z and grow this thing, there's there's actually a little multiple arbitrage in there too as well. So if you're at 1 million in cash flow, you're on the line, you're a tweener. If you've got the energy and you can pump this thing and get it to 1.5 million, it's going to grow the company not exponentially, but at an accelerated pace. So that's one reason why we do the valuation up front, so that we don't have surprises before we actually, we date before we get married. Before we get married with a client,
Right.
we are going to know some of those things and make sure we're on the same page. There's no gap in expectation or anything like that. So um, that's one reason why we do that. So we can lay that out. And if it's not time, they can understand how these things are valued, what the market says, and if they're close to that line, maybe make a few introductions. For instance, we see a lot of clients that do no marketing, no advertising. They've been around and the phone rings.
Right.
And well, if you're on that line, maybe you make a little investment in advertising and try to grow it a tad. That's just an example.
Right.
We don't do that work, but as far as doing that consulting, so to speak, to help them grow, but we just shine a light on what we see and the way deals are done and the way things are valued. And if they're on that line, they've got a decision to make: write it out or try to grow it.
Okay. Awesome. Awesome. Well, I've got as we wrap up, I've got one more question in two parts. So, um, so I think these are kind of related to one another, which is why I phrase it that way. But let's assume I'm a seller. So you're speaking to a seller. What are maybe like what's one of the biggest mistakes that you see sellers make in this process? And related to that, what would be maybe one or like your best tip or two on how to help a seller get the most money for their business?
So the biggest mistake, you mean during the process of selling,
Yeah.
not so is if they don't take our word for it. We try to be from the very beginning very transparent, just open book, and we're fair to both sides as well. Buyers usually give us a lot of great feedback, um, but sometimes it's things like, "Hey, I wouldn't use your attorney. Your attorney's done zero SBA deals, but they use their attorney anyway. Like
Mm,
you're paying us good money because we know how to do these deals. So take our word for it. Obviously, there's
right.
sometimes we're presenting options to you, or sometimes we're um, leaning in on something that you could go one of two ways. But if we give you some advice on stuff like that, do it. I'm going to give you
Right.
three bankers, but use one of these banks, right? You don't
Right.
don't don't go against what we say, because almost every time that comes that comes back to bite us. And it not from a losing the deal, but just in time, and time kills deals. And I would say that to buyers, like buyers, it's more with buyers, where buyers are not our clients. And one thing that we want to do along the way is show them, hey, look, we're fair. We're representing the deal now after we're under contract, right? Um, and we're not gonna gouge you, but hey, do do this and that and this so that we can get this deal done, right? That's
Right.
good for all of us. And so that's the number one thing. And what was the second question?
Just the biggest, best tip, if you will, on how to get the most value out of your business when you are thinking about a sale.
You know, good books and records, number one. Do you have and that's not just from a standpoint of are they accurate, but little things like depending on the business, but is gross profit, is that fairly accurate? Little things like that. Like, do you have, I would use somebody like Vark to do the books. Most, unless you're big enough where you've got a staff and
Right.
internally, most people should outsource that to get people that know what they're doing and know about accruing payroll or all those little buzzwords. I would outsource that and get it done right. Do you prepare for it? Like we talked about with the tax returns. Don't just wake up one day and want to sell. Start talking to someone like us 3 or 5 years out. Take control of timing, because you never know what may happen. Um, and I would look at things that, like we talked about spending money on advertising. Uh, the buyers are going to do that, and they're going to grow the company. Now, some clients don't, they're maybe 62, and they don't want to spend that extra money or time, but uh, there are some sellers that leave some money on the table there because they're not maximizing that cash flow. Sellers always ask, will I find that stupid buyer that will overpay? The answer is, if you find any stupid buyers, you let me know where they are. Buyers will tear that thing up and down looking for the details. Cash flow drives the day. So get out in front of that, get as much cash flow as you can, and have good books and records. Scale yourself out of a job. Have a good team. If you can't go on vacation for a month and the business isn't going to run well, then you probably can't sell it. And I think those are the keys.
Well, those are incredibly good tips. So, in summary, what I heard there was if someone is going to pay for your services, trust in your in your services.
Yes.
Listen to your recommendations. Just because I've got a buddy, that I think is a really cool guy, for that I could use for part of this. If this person hasn't done the types of deals that we're talking about, yeah, he might be a good buddy, but I'm not going to use him, right? Or at least you guys would be advising, hey, the deal might not get done if you go that route. So, listening and appreciating the recommendations that you give, love that. The other thing I heard there, and I'll use my own phrase, but if you've still got your mother-in-law doing your books, um, probably need to think about professionalizing those so that you have not just clean, accurate books, but somebody outside your company that's got a second pair of eyes, making sure that things are good and consistent and clean. Those are definitely great recommendations. So, Jackson, really again, thanks again for you taking the time to share your expertise. If somebody wanted to learn more about you guys, how do they get a hold of you?
Hey, vikingmergers.com has a lot of information where you can kind of get your own education, tons of videos, tons of valuation tips. Um, and you can click on the connect with us or whatever it is link and get right to us. They can also email me directly at jpayne, Payne, at vikingmergers.com. I'm happy to talk with anyone out there that's got questions.
Awesome. Thanks again. Appreciate it. And for those of you that are listening, I hope you got some value out of this podcast. And hopefully, it'll also help you if you are ever thinking about buying or selling a business. So, uh, appreciate you listening in, and we will talk to you again next week. There is a Solution for That is produced by VARK Solutions. This episode was produced by Ashley White and Aaron Riley. You can subscribe to this podcast on Apple Podcasts or Spotify. Watch the video version on youtube.com/theresaSolutionforThat. Or visit TheresaSolutions.com/podcast, where you'll find our entire podcast archive, as well as show notes, links to solution providers, and complete transcripts of every episode. If you love the podcast, please leave a review with your comments.